Indians are number one in borrowing. From farming and home loans to gold loans, debt has risen everywhere. RBI's figures will leave you stunned. It is around 11 at night. In a lane of a small town, the shutter of the last shop has already come halfway down, but the light inside is still on. The shopkeeper is sitting on a wooden chair, pressing the calculator. On one side is the calculation of his son's college fees, on the other side a tractor installment, on the third side the cost of repairing the house, and on the mobile screen a bank message is flashing. Pre-approved loan available. He keeps looking at the screen for a few seconds, as if both relief and danger are hidden inside that message. This is the story of India today. People are taking loans, taking them fast, taking them for every need. But the real question is, does this rising debt signal progress, or is it a silent sign of pressure building up ahead? Today, a very interesting picture of India's economy is emerging. According to RBI's latest sectoral deployment data, in the fortnight ending the 28th of February 2026, non-food bank credit grew 14% year-on-year, while in the same period last year, this growth was 11%. This data has been taken from 41 select, scheduled commercial banks, whose share in total non-food credit is around 95%. That means this is not a small sample, but a picture that shows the direction of almost the entire banking system. When bank credit grows this fast, it means that in the country, not just spending, but expansion, aspiration, and pressure. All three are rising together. But one thing is very important to understand here. Rising debt is not bad news by itself. If a farmer is taking a loan for seeds, irrigation, or machinery, if a family is taking a home loan to move out of rent and buy its own house, if an industry wants to install new machines and increase production, then credit growth can become the lifeblood of economic activity. The problem begins when debt starts running faster than income, or when lifestyle starts depending more on loans than on earnings. India's story right now seems to be standing at exactly this crossroads. On one side, credit-led growth, on the other, the fear of debt-led stress. That is why RBI's figures are not just banking data, they are also a mirror of changing social behavior. The most attention-grabbing thing is that this borrowing is not limited to just one pocket or one sector. Credit given to industries rose 14%, while a year earlier this same growth was 8%. According to RBI, this rise was driven by sectors like infrastructure, engineering, chemicals, petroleum-related products, and textiles. In simple words, from factory floors to large project sites, money is moving, expansion is happening on borrowed money, and corporate India too seems to be leaning more toward bank lending. The positive meaning of this is that the hunger for investment has not ended yet. But the negative reading could also be that this wheel of growth is spinning more on debt fuel. The picture of the services sector is no less interesting. In this segment, credit growth stood at 16%, which is quite above last year's 18%. According to RBI's data, this growth was supported by segments like NBFCs and commercial real estate. This means that not only factories or farms, but financial intermediation and property-linked activity too are moving ahead rapidly on borrowed funds. When NBFCs borrow more, its effect reaches the common man through many routes. Vehicle finance, consumer loans, small business lending, gold-backed borrowing, all of it. In other words, this wave of debt is moving in both directions, top to bottom and bottom to top. The picture in farming too says the same thing. Credit dependence is increasing. Bank credit for agriculture and allied activities rose 12%, while in the same period last year, it was 11%. At first hearing, this growth may not sound very alarming, but behind it is hidden that rural reality of India where farming is no longer just tradition, but is becoming a high-cost activity. Diesel, fertilizer, seeds, pesticide, labor, irrigation, machinery. The cost of everything has risen, and after that the need for working capital for the farmer has also increased. In many places, before the crop cycle begins, the loan becomes a survival tool, and after the harvest comes in, it becomes a cause of repayment tension. So calling agriculture credit growth only progress would be incomplete. It also contains a reflection of rural pressure. But the real story appears most sharply where the life of the common man is directly connected. Personal loans. According to RBI, the personal loan segment recorded annual growth of 15%, while a year earlier it was 12%. This is the category that reflects the heartbeat of middle class, lower middle class, and aspirational India the most. Here there is home loan, vehicle loan, gold-backed borrowing, and also borrowing that is directly linked to consumption. This growth tells us that India is no longer just a society that earns and then spends. It is also moving rapidly toward a model of take today, repay tomorrow. The most interesting turn in this personal loan story is visible in gold loans. Reports by RBI Business Standard, based on RBI data, say that loans against gold jewelry in February 2nd, 2026 jumped by around 128% year-on-year, and the outstanding portfolio reached nearly 4 trillion. Just think, this is not just a number. It is the story of that psychology in which Indian families are keeping their most trusted household asset, gold. with the bank for emergency, marriage, business cash flow, education, or short-term liquidity. In earlier times, gold was the safety of the locker. Now that same gold has become a liquidity machine. This rise shows both opportunity and stress, because a gold loan is often taken when cash is needed immediately and formal unsecured credit feels expensive or difficult. The growth in vehicle loans also says a lot. According to RBI linked reporting, vehicle loans grew 17%, which is much faster than last year's 10%. One face of this is aspirational India. A new car, two-wheeler, commercial vehicle, better mobility. But the other face is that transport, delivery, small logistics, and livelihood-linked mobility too are resting on credit. For an urban family, a car may be convenience, but for a small transporter or a self-employed person, that same vehicle becomes a source of income. So vehicle loan growth writes the story of not just consumption, but income generation and social status together. The housing story is a little different. According to RBI linked reports, housing loan growth remains steady at around 11%. This means that the dream of owning a home is still strong, but there is no wild surge in it. In India, a home loan is a long-term commitment. This is the kind of debt people see not as a compulsion, but also as asset creation. But behind this steady growth there is another truth too. That property prices, EMI burden, the interest rate cycle, and urban cost of living have made home loan a decision that is taken very carefully. People want to buy homes, but now they are also beginning to understand the trap in which EMI, maintenance, furnishing, and job uncertainty all stand together. Now the question arises, has India really become number one in taking loans? If this line is read like a global ranking, then such a claim cannot be made without verified data. According to RBI's Financial Stability Report, India's household debt had reached 41% of GDP by the end of March 2025, which is above the average of 38% over the previous 5 years. But this same report-based coverage also says that this level is still lower than many peer emerging economies. So globally, we may perhaps not be at the very top, but within our own recent history, household debt has risen sharply. So the real truth of the headline is this: borrowing culture is deepening in India, household leverage is rising, and credit is becoming not an extraordinary part of life, but a normal one. One more thing becomes very important here. According to coverage based on RBI's December 2nd, 2025 Financial Stability Report, household liabilities had reached 41% of GDP, and a large share of debt seemed to be shifting toward non-housing retail loans. This means that borrowing is increasing not only to build assets, but also for consumption-led needs. When debt moves away from house building and toward everyday lifestyle, mobility, short-term needs, or personal liquidity, then the character of repayment stress also changes. In asset-backed debt, at least something tangible gets created. In consumption debt, future income is often already eaten up in advance. There is an optimistic way to look at this entire trend. Someone may say that credit penetration is rising, the reach of banks is expanding, the formal economy is becoming stronger, and people are moving out of informal money lending into a regulated lending system. This argument is not wrong either. If a farmer is taking a bank loan instead of borrowing at moneylender interest, if a small business is expanding through NBFC finance, if a family is pledging gold and avoiding a distress sale, then formal credit can work like a safety net. The democratization of credit is necessary for any emerging economy. But the other side of it is just as real. Taking a loan has become easier, but repaying a loan still demands discipline, income stability, and financial literacy. In the world of app-based approvals, pre-approved messages, instant offers, and easy EMI, borrowing has now also become a psychological temptation. A bank or lender gives you money today on the strength of your future income. But life does not always move according to a spreadsheet. Illness, job loss, business slowdown, crop damage, family emergency. Any one of these things can shake the repayment journey. So before celebrating credit growth, attention will also have to be paid to repayment resilience. If the sharp rise in gold loans is seen from this angle, the picture looks even deeper. In India, gold is not just jewelry, it is also an emotional reserve. When a family takes a gold loan, many times it is using its emotional fallback before financial planning. That is why the explosion in gold-backed credit is not just a finance story, it is also a household vulnerability story. It is easy to assume that people are only using smart leverage, but in many cases this may also be a sign of cash crunch, especially when income growth is not as fast as credit growth. Industrial borrowing too should be seen through a layered lens. Rising credit in infrastructure and engineering can be fuel for growth because it affects roads, projects, logistics, manufacturing capacity, and supply chains. But if borrowed expansion becomes much faster than demand, then it can create future stress. In India's economic cycle, this tension always remains. When does credit become productive investment? And when does that same debt begin to turn into a burden on the balance sheet? So it is easy to feel happy just by seeing growth in RBI data, but the next chapter of asset quality and repayment discipline will be just as important. A subtle change is visible in rural India too. Earlier, debt was often associated with shame, compulsion, or crisis. Now in many places,
Loans are being seen as a growth tool. Tractor loan, dairy finance, irrigation equipment, warehouse support, agri-input borrowing. All these can be signals of economic ambition. But when monsoon, MSP, input cost, and market prices are uncertain, that same loan can become a stress multiplier. India's farmer often faces risk before profit, and credit turns that risk sometimes into a cushion, sometimes into a burden. So the rise in agriculture credit does not mean only that farming is becoming modern. It may also mean that farming is becoming cash intensive and debt dependent. The story of the urban middle class is even more complex. On one side, people have already accepted EMI as a part of financial planning. House EMI, car EMI, gadget EMI, education EMI, insurance premium, school fees. Among all these loans have become normalized. On the other side, pressure on savings behavior is increasing. When debt becomes a permanent part of lifestyle, the ability to absorb shocks can weaken. That is why experts do not see the rise in household debt just as a macro number. They also connect it with future consumption, savings patterns, and financial stability. There is also an interesting contradiction here. India has traditionally been considered a savings-oriented society. Families used to buy gold, buy land, build a house slowly, and match expenses not to future income, but to past savings. But now credit-led behavior is rising rapidly. This may give the economy a short-term push, demand may look strong, sectors may get liquidity. But if this borrowing is not supported by productive capacity or stable income growth, then this same trend can become the basis of future distress. History tells us that as long as credit remains within discipline, it is a growth engine. Once it goes out of control, that same engine starts overheating. So should we get scared? Maybe not. Should we become carefree? Absolutely not. RBI's February 2nd 026 figures make one thing clear enough. That the hunger for debt has increased in India. And this hunger is not limited only to large industries, but has spread across farms, homes, vehicles, jewelry, and personal finance too. Non-food credit 14%, industry 14%, services 16%, agriculture 12%, personal loans 15%. Together, all these numbers say just one thing. Borrowed growth has now become a major chapter of India's economic story.
Taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.